What's your first takeaway? Big, interesting meeting, but what's your main headline for the day?
Yeah, so I think it's what it looks like, which is the market was expecting a somewhat more dovish outcome than they got. The market always stays a little bit ahead of the Fed, so the futures market is pricing in more hikes than even the Fed expects. But those 2 hikes in 23, I think, caught a bunch of people off guard.
And so we saw that reaction in bond yields, but I mean, we're still at about 1.5%. Sure, we had some big standard deviation moves, particularly in the 2-year, but overall, do you think that we've got further to sell off when it comes to the US Treasury market?
Well, I think it's just what Chair Powell mentioned, which is it's a very uncertain time. It's very unusual or unprecedented. I hate to use the word unprecedented. It's used entirely too often, but it is, in this case, that. And so we shouldn't, like he said, read too much into the data. We have to see how things ultimately play out, because the kind of inflation we're seeing locally is related to the supply shortages that were referenced, and those things tend to work themselves out. So the real question is, will this turn into some sort of self-perpetuating cycle that requires a more aggressive rate hike path? And you can see from their projections over the medium term, the 21 forecasts moved up on the inflation side, but their medium term unemployment and growth forecasts really haven't changed. So I think those 2 hikes in 23 that everyone's focused on really reflect a risk management and academic honesty of the committee, right, basically saying we don't really know, but the distribution of possible outcomes is skewing in a slightly different direction.
Yeah, let's talk about that risk management approach, because I thought that was interesting. Every time the subject of the labor market came up during the press conference, Chairman Powell sounded very optimistic. He's like, we're going to get back there, and if there's any slowdown right now, maybe it's due to COVID or childcare or the expanded unemployment insurance, and that'll take care of itself. He didn't seem worried about the jobs market at all. Now, maybe it'll take a little while, but we're going to get there. All of the risks, in his view, could be more on that inflation side. Is there any inconsistency? And I guess this is the big question. Is there any inconsistency between the what was laid out today versus the sort of post-Jackson Hole framework that we've been operating on really since last August?
Well, I don't think so. They're keeping rates at 0 through the end of 2023. So even this talking about tapering, which we're, I guess, not supposed to call it that anymore, but we're talking about a very unusual level of stimulus that's to persist for a sizable period of time. I mean, the fact there's 2 hikes at the end of 2023 means rates are at 0 well through the reopening and subsequent return to normalcy, assuming everything goes well on the public health side. So they are definitely willing to let inflation run through the target, consistent with their FATE framework. The forward average inflation targeting means that the economy is going to run hot for a while. I don't see any inconsistency here. I think what's happening is the reopening is generating more inflationary pressure on the front end than people expected, and is frankly going better than a lot of people expected. And the risks still lie in the medium-term path, the rise of variants and public health concerns and rate of vaccination slowing and all these other things that are sort of not my day job or my training, but we're sort of forced to confront all these things that we don't necessarily know that much about to start with. We all try to learn, and we're in a very unusual environment, and I think the chair is right to be cautious, but to recognize the fact that, again, that distribution of risks, the tail outcome is slightly to the higher side on policy rates.
Your day job is monitoring rates, even short-term rates. Your day job is looking at financial stability, and it's indeed part of the Fed's role too. There were some rate rises. They were very much on the shorter end. Of course, we've seen record amounts of repo being used. We've seen short-term rate adjustments, therefore, giving a little bit of a reprieve to some of these banks that are trying to find places to park all this cash that's going on at the moment. How do you monitor and how do you feel about financial stability at the moment and the role the Fed's playing there?
So there's no acute financial stability risks here. I think the concern the Fed has, and we share it, is that if this were to continue, then if money market funds are essentially working for free, they're going to start turning away money. Those are soft closes that everyone's concerned about. And then the question is, where does the cash go if it can't go into the money market funds and through them back to the Fed? Because ultimately, I think what we're finding is that the Fed's ongoing purchase program, combined with drops in the Treasury general account balance, is putting too much cash in the system. That cash is not needed, and it's finding its way back to the Fed. And now QE still has stimulative effects beyond just the creation of new cash and substituting it for securities. I mean, that's one channel through which it affects financial conditions. But that cash has to find a home, and what the Fed's trying to do is ensure that excess cash ends up back at the Fed instead of in other areas of the market where it could cause more instability.